Well, we believe that most equities are valued efficiently by the market. And so we focus all of our time and effort trying to identify and better understand situations that are changing and evolving. It could be a specific company. It could be an entire industry. And by focusing all of our time on those types of situations, we feel like we can do a better job of analyzing more complicated equities, things that may not play out in the near term and may take several years.
Like what? What's an example?
So, for example, the implementation of the Affordable Care Act. It's a very complicated law. There are elements of it that many people immediately noticed, notably that the uninsured will become insured. But we noticed something that most people missed, and that is that there's a clause in it called mental health parity, which is going to require healthcare insurance plans to cover mental health facilities in the same way they cover acute care hospitals. This is going to cause a huge increase in capacity utilization for those who manage and own mental health facilities. And there's a couple of public companies that are players in this area. One is called Universal Health, and they're going to see a big benefit in 2015.
How long does it take? If you're evaluating an industry or a company that's going through a change, how long do you have to wait to see that change come to fruition? Because hedge funds today have to offer their investors more and more liquidity. They've got shorter and shorter timelines. How can you have that kind of iron gut?
That's a really important point, because hedge funds do offer liquidity, but we really don't know how to invest short term. I feel that
we don't know how to invest short term.
Investing short term is a recipe for failure. Our clients understand that, thankfully, and we benefit from having great long-term investors. And so our typical position might be in our portfolio 2, 3, 4 years. These things take time to play out. In our view, the near-term events are crowded. They're event-driven hedge funds. They're all over it. We don't want to compete with them. We want the longer-term situation.
But you're investing in liquid securities that you could sell if you had to.
Absolutely. We only invest in liquid securities. The more liquid, the better, frankly, because when you make a mistake, you want to move on, and you want to move on immediately.
So, Affordable Care Act is one. What are some of the other catalysts? Is it appropriate to call them catalysts that you look for?
They're soft catalysts. They're evolutions. Sometimes they're quite subtle. For example, the cable bundle we see is breaking. And there are channels that are absolutely critical that viewers want to watch.
Like Bloomberg?
CBS, NBC, Bloomberg. You know, for me, it's
ESPN.
FX, ESPN.
FX? Why? What do you watch on FX?
I love those shows. They're amazing shows.
What's on FX?
I'm astonished at how good the league is. And
I don't know what that show even is.
You haven't been spending enough time on FX?
Get my FX game
it's a great channel. Trust me, it's fabulous. It's almost as good as Bloomberg. But there are other channels that are not so important. And as the cable bill's gone up and up over time, consumers are angry, and the cable companies are now putting their foot down. There have been examples of negotiations within the last year where some smaller cable systems have thrown out certain channels, and it's clear that the financial opportunity really remains for the important channels, for those who own the best content, and everyone else is at risk. And I think that's a very important change. And there are various ways to play it, going long the winners, short the losers. Of course, this whole trend towards over-the-top and digital monetization, it's an incredible change as well.
Let's talk about some of the companies that you think will win and some of the companies you think that will lose in a world of over-the-top.
I think the winners are somewhat obvious. Fox, for example, they happen to own that network that I'm a fan of. But their larger networks are perhaps even more important. CBS, ESPN, you pointed out as well. These are critical channels. They're going to be the winners. They're going to capture more and more of the money as time goes on, especially because they dominate in sports, which has to be viewed live. The channels that don't have sports and don't have content deemed critical by the viewer are in trouble. I'd rather not disparage any or name names today, but I think you can turn on your cable system and scroll through the channels and you see a few examples of things that you'd never be that interested in.
What sectors do you think are ripe for change that we might not be focused on?
Well, I think the precipitous decline in gasoline over the past few months, combined with the strengthening job numbers, is a recipe for the consumer sector to recover. It's been a disaster for years. The U.S. consumer's been hurting, particularly the low-end consumer. And these companies have struggled. You can
What kind of companies?
You can still invest in low-end consumer companies who are announcing bad numbers, and yet they're poised to recover. It's a perfect time to invest in them.
Like what companies?
So I think convenience stores like Dollar General and Dollar Tree are poised to recover. There's a rent-to-own type company called Aaron's. Some people call it Aaron's. That's poised to recover.
Are they in Texas?
They're all across the South, and it's a really interesting situation.
Is it early to get into that trade? I feel like that was one of those companies that Meredith Whitney loved and made a lot of sense to her, but maybe it was too early. The past 2 years, it's been early to be in those kind of trades.
Yeah, those companies have struggled, and we've had some success being short those same companies over the last couple of years. But now it's a time to get long those companies. These are generally well-managed and really poised to grow a lot.
Are you generally net long?
Yeah, our fund always runs modestly net long. We believe that in any given year, we can't predict the direction of the market. However, over 10 years or 20 years, the market generally drifts higher. We want to benefit from that. So we never want to be too net long that it's troublesome, but we definitely want to be net long over time.
And how do you feel? So yes, over 10 years the market drifts up, but do you feel that the prospects for, let me put it this way, are the prospects for the stocks that you're long better in 2015 than the prospects for the stocks that you're short?
Oh.
Yeah, that's exactly how we would think about constructing our portfolio. We don't know the direction of the market. We just want our longs to outperform our shorts. So we're long companies like the consumer companies I mentioned that are about to get a tailwind, where something is changing, something is helping them. There are other examples, like for example, Constellation Brands, which is a fabulous company that is a domestic distributor of beer and wine. That's really poised to not only cut their costs, but grow their sales.
Why? What specifically about them?
They have a fabulous demographic. They're distributors of Corona, Pacifico, and Modelo.
I like all three of those.
Yeah, well, Peter Lynch said, buy what you know. They also are cutting their costs. They use about 4 billion glass bottles a year. They've been paying approximately 18 cents a bottle for them. And late last year, they cut a new contract that's going to eventually allow them to get those bottles for 13 cents. So 5 cents isn't a lot to save, but multiplied by 4 billion, that's
a lot of sense.
Yes, indeed. You were saying that you want your longs to outperform your shorts, but I was talking to another hedge fund manager on Friday night, and he said, my longs have been doing great, but I'm getting crushed on my shorts. Over the past 2 years, it has been tough to be short.
Sure. Short selling's not easy. It requires a lot of work and a lot of creativity. It also requires a lot of people to be thinking. No one person can come up with enough shorts to fill a portfolio. So at Highline, I benefit from a lot of people around me who are great short sellers. And we're finding companies that are losing market share, that are having supply problems, companies where there's something wrong with their end customer. And enough of those in a portfolio may not necessarily earn us absolute returns in a given year, but it'll certainly earn us alpha, meaning those shorts will underperform the market.
Will they always underperform, though? What we've seen, this market has rewarded crap companies, right? The companies that, under normal circumstances, are supposed to be feeling the most financial pain, you know, broadly speaking, have been some of the best performers.
Like what?
Companies with very weak balance sheets. You know, companies that have junk bond ratings, for example.
Okay, I'll give you that.
Well, I'll tell you what, in an environment of low interest rates and narrow spreads, yeah, those crap companies will outperform. But close your eyes and open them 2 years from now, and interest rates may be a little higher, and spreads may be a little wider, and those companies may not do so well in that environment. So this perhaps could be a wonderful point at which to re-engage with some of the shorts that one might consider crappy.
Of everything in your portfolio, do you have a -- favorite position?
Yeah, it's the Intercontinental Exchange, or ICE.
Mm-hmm.
Based in Atlanta, incredible CEO.
Jeff Sprecher.
Yes. Sprecher's really smart. We have a lot of faith in him. This is a company that is the dominant player in energy futures. And so the exchanges that they own and that they manage, for example, have the dominant market share in Brent crude. And as the market becomes more volatile, there's more and more trading in these futures. They're a direct beneficiary of this. In addition, they trade some short-term interest rate futures, and as interest rate policy over time evolves, they will also benefit.
How do you feel about the cash equities business?
The cash equity business, about 9% of ICE's revenue. They own the New York Stock Exchange.
Should they spin that off? As I like to call it, the museum downtown?
You know what they should do? That's very funny.
It's a great event space.
What they should do is cut costs, and there's a plan to cut $550 million in costs at the New York Stock Exchange. There's so much obsolete technology that they can improve and replace.
Like human beings?
You know, I was an intern on the floor of the New York Stock Exchange.
I'm joking.
I have friends there. But they're gonna make that more profitable. Margins can go much, much higher. And if at that point the market doesn't reward them with a higher multiple, yeah, they should spin it off. And I think they will.